4th. On this particular day right here, the predicted high can jump down, they can fake you out, they can penetrate something. There's a lot of jabs and so forth that you want to protect yourself against. So what we're going to do is we are going to establish kind of as a little bit of a leeway for us and try to avoid those types of situations. We're going to use a $10 leeway before we're going to get into the market. In other words, it has to exceed the predicted high by $10 before we're going to enter the market. You know, just give it a little room to breathe if it wants. In this case right here, that means if we were doing this, we would be getting into the market at 1113. That's the predicted high, 1103 plus 10 at 1113. Now, there are various ways that you can trade once you get in. As you probably are aware, if you have traded gold, the margin or the performance bond, as the industry prefers to call it, for a full-size gold contract is something like $6,700, which makes it pretty rich for anybody who has a relatively small account. So you may want to be looking at the mini contract, the 1/3 size contract. The margin of the big one, $6,700. The mini contract is more like $2,500. I don't know what the exact latest performance bond is for the mini, but somewhere around $2,500. And the reason I'm suggesting the mini is because with the smaller accounts, you want to be able to have some flexibility and ability to get in and out, you know, just kind of like the big boys do. If you have a big account, you don't have to worry about it so much, but you want to be able to get out at certain points and to set up an account, or set up a trade rather, that gives you that opportunity. In this case right here, we talked about getting in at 1113, and again, we're going to set an arbitrary target. We're going to say that if I get a $20 increase in profit, I am going to take some profits on at least one of the 3 contracts. I'm going to be trading in 3 contract multiples. So that puts your target at 1133 for the first target that you would get out of those 3. Now, this one was hit on January 6th. That was hit. And you had $2,000 that you had in your pocket from at least one trade. If nothing else happens, you at least have some money. I know there is a maxim in trading, let your profits run, and I agree to a certain extent. There are some times when that is the case, like if you get the run-ups in, let's say, oil that you had a couple of years ago, or commodities in general a couple of years ago when the hedge funds were buying and making kind of a big bull market situation. There are times when you do want to let it run, but in more recent times, it seems like the market is a little bit more choppy, back and forth, ranging within, it's volatile, but still it ranges back and forth. And so the trends that are there are, sometimes they're good. You don't know when it's going to be, but sometimes they're not there. And so on the side of caution, I'd like to be able to put a little bit in my pocket and trade with the market's money if I have a choice, as opposed to going, just trying to hang on for the last dollar and take all the profit out that I possibly can. Now, in this case, I mentioned we were at 1133. We hit that one. We almost got knocked out. In this case right here, you can see that the market extended below the predicted lows. Should have mentioned, as I said before, that when we get into a market, the first thing you want to do is you want to set a stop that you can live with. If I got into the market, I probably would set a stop at the predicted high, because I don't want to risk more than $10, or in the full-size contract, that would be $500. I don't want to risk more than that with my little account, so I have to be a little bit careful. That I'm going to, after I get a little bit of movement and the market moves up, I'm going to keep a trailing stop below the predicted next day low, as long as I can, have that above my entry point, so that I'm not jeopardizing the profits that I have. Now, the next possible point that I talked about, if we're talking about the $20 increments at which we're going to try to trade, take our profits, is going to be in the vicinity of 1153. Now, these probably aren't exactly perfect. I can't see exactly on my screen exactly where these things line up, but at 1153, you'd have a profit, in this case, with this contract, of $4,000. So now you have 2 trades, 2 or 3 contracts. Out of 3 contracts, you have 2 contracts which you have made some money, and so you're ahead. The next target would be, $20 beyond that, 1173. But sometimes with that third target, as long as you have pocketed some of the market's money, would be to kind of let that ride a little bit, or just to see where the market might take you. So you may not want to set a stop out point with that at 1173. You might want to let the market work out a little bit and see where the possibilities might go. In this case, we had the situation where the market did, go up beyond there, got our 2 contracts for profit, but then we started to hit kind of a down point here. We started to have, as you can see down here below here, the predicted differences turning down, change in situation with the neural index dropping to 0. So there were some bearish factors that were starting to shape up here. And in this case, the stop out point would have been right here. We're talking about the market having reached a predicted low in this particular case here at 1134. So this would stop us out at 1124 roughly on one of these 2 days. I'm not sure exactly which day you might have got out because this was a very close to being 1124 right here. But at some point right in here, you would have been out at 1124. I know that's not your 1173. It's a little bit short of that target, but still in this third contract, you had a profit of $1,100 from where you got in. So you put those 3 contracts together, the full-size contracts, and you would have a profit of $7,100, which isn't too bad for a short-term trade. Again, probably risking maybe a little bit more than you'd like to risk, but with you small accounts, you'd have to take a little bit more of a chance and try to find out, where at what point are you going to have to get out? What can you tolerate in terms of your risk propensity? Now we're going ahead a little bit, skip ahead. We have a situation right here where the market starts to move down. We had the predicted high. I should have pointed out right here, we should have a predicted high on this particular day. Now this depends if you're really smart and you really assume the market is going to go down based on the indicators that I pointed down here below, where you have your differences moving down, your neural index at 0 and so forth. If you're really confident that it could go down, you could say, okay, I am going to fade this predicted high, and the predicted high was at 1144. And the actual high was something like 1142. So you could put a stop, depending again, a limit order rather, somewhere in the vicinity 1141, 1142 or whatever. And if it gets above there, go short and ride the market down. Obviously, you don't know if that's what's going to happen or not because, this is a situation where it did meet the high. It is for active traders only to trade this type of a signal, but may not be your style. I'm not sure. I'm not going to speak to you, but you can determine exactly what you're going to do when you trade. Now we talked about this high, the predicted low rather, right in here, 1134.